Every year, the average investor who tries to time the market underperforms the market itself by roughly 4 percentage points annually. And over a 20-year period, that gap compounds into a portfolio worth nearly half of what a simple buy-and-hold strategy would have produced. That is not a rounding error. That is the difference between retiring comfortably and working an extra decade because you panicked at the wrong moment. The numbers are brutal and consistent. A study by J.P. Morgan found that if you missed just the 10 best days in the market over a 20-year span from 2003 to 2023, your total return would have been cut by more than half. Here is what makes that statistic terrifying. Many of those 10 best days occurred within days of the worst days. The market does not politely schedule its recoveries on a Tuesday after a calm weekend. It explodes upward in the middle of panic, in the middle of headlines screaming collapse, in the middle of the exact moment when every instinct in your body is telling you to sell. Investors in 2020 watched the S&P 500 drop 34% in 23 trading days during the COVID crash, and then watched it recover all of that loss in just 126 trading days. The people who sold at the bottom locked in catastrophic losses. The people who did nothing, or better yet bought more, watched their portfolios surge. This is not a one-time anomaly. It is the pattern. It has repeated in 2008, in 2011, in 2018, in 2022. Every single time, the people who tried to time the exit and re-entry got burned, and the people who stayed the course came out ahead. So why does this keep happening, and what should you actually do instead? Let us start with the psychology, because that is where the real damage lies. Human beings are wired to avoid loss far more intensely than they are wired to pursue gain. Behavioral economists call this loss aversion, and it means that the pain of watching your portfolio drop 20% feels roughly twice as powerful as the pleasure of watching it rise 20%. That asymmetry is not a minor quirk. It is the engine behind every bad market timing decision you will ever make. When the market drops, your brain floods with cortisol, your amygdala hijacks your prefrontal cortex, and you sell. You tell yourself you are being rational, that you are protecting your capital, that you will buy back in when things look safer. But things never look safe when the time to buy is right. Things look safe after the recovery is already well underway, and by then you have missed the move. Now layer on top of that the information problem. Professional fund managers, the people with Bloomberg terminals and teams of analysts and decades of experience, fail to beat the market roughly 90% of the time over a 15-year horizon. If they cannot do it, the idea that you, checking your portfolio on your phone during lunch, are going to nail the top and the bottom is not optimism. It is delusion. The market is a discounting mechanism. It prices in everything that is known, everything that is expected, and a significant portion of what nobody expects. By the time you see the news that justifies a sell, the market has already moved. You are always late, always. The data on this is overwhelming. Dalbar, a financial research firm, has published its quantitative analysis of investor behavior report for decades, and the conclusion never changes. The average equity fund investor consistently earns significantly less than the funds they invest in because they buy after rallies and sell after drops. They chase performance. They flee from pain. And the gap between their returns and the market's returns is not small. Over the 30-year period ending in 2023, the average equity fund investor earned roughly 3.7% annually, while the S&P 500 returned approximately 10.1%. That is a chasm. That is the cost of trying to be clever. So what works instead? The answer is boring, and that is precisely why most people reject it. You invest consistently, you diversify broadly, you keep your costs low, and you do not touch the thing. You set up automatic contributions into a low-cost index fund, you rebalance once or twice a year, and you go live your life. That is it. There is no secret. There is no edge. The edge is the absence of interference. Let me give you a concrete example. Suppose you started investing $200 a month into a total stock market index fund in January of 2008. Right before the financial crisis. You would have watched your portfolio crater. You would have felt sick. But by 2024, that $200 a month habit, left entirely alone, would have grown into a substantial sum, because you bought shares at every price point, including the terrifyingly low ones that only existed for a brief window. Dollar cost averaging is not a strategy you have to think about. It is a strategy that works precisely because you stop thinking. The other piece most people miss is what happens to the people who get out and then fail to get back in. Re-entry is harder than exit. When you sell, you feel relief. Relief is addictive. You watch the market drop further and you feel vindicated. Then it starts to recover and you tell yourself it is a dead cat bounce. It keeps recovering and you tell yourself you will wait for a pullback. The pullback never comes, or when it does, it is not enough to justify the gains you already missed. Studies show that investors who exit the market during downturns typically wait an average of 6 to 12 months before reinvesting, and by then they have missed between 20 and 40% of the recovery. The exit is easy. The re-entry is where the real wealth destruction happens. There is also a tax dimension that most market timers ignore. Every time you sell at a profit, you trigger a capital gains tax event. Frequent trading turns what would be long-term gains, taxed at favorable rates, into short-term gains, taxed at your ordinary income rate. Over a career of trading, you can surrender 10 to 15% of your total return to taxes alone. A buy-and-hold investor defers those taxes indefinitely, allowing compounding to work on the full amount. The government is essentially subsidizing your patience. The final thing I want you to consider is opportunity cost of attention. Every hour you spend watching candlestick charts, reading analyst opinions, and debating whether the Fed will cut rates in September is an hour you are not spending on the things that actually build wealth in your life. Your career, your skills, your relationships. The highest returning investment most people will ever make is in their own earning capacity, and market timing is a full-time distraction from that. The market does not reward the smartest person in the room. It rewards the most patient. And patience is not a personality trait. It is a system. Build the system, automate it, and let time do what it has always done.